price, market value of equity, that's how much you need to pay if you want to get the stock in the market. So that's a trading price. Okay? Earnings profit. I mean, these two words can use interchangeably. So that's money made by the firm during a period. Usually I use that for 1 year. So how much money the firm make. So not you make, the firm make. Okay? The book value of equity. So that's price, the market, the trading value. Book value is recorded value. That's basically historical value. So how much money they invested, really invested in the firm. That's book value. Return, I don't know if you can see clearly, but basically that's what you can get based on your investment. So this is the price in this period. That's the dividend, the distribution from the firm. Usually that's 0 in China. So T minus 1, that's price you paid last period. And minus 1, that's the return you get. Okay? That's how much you earn by purchasing the stock. That's PE ratio. That's very commonly used in the media in the analysis. That's price divided by EPS, or market value divided by profit. So that's the total worth of the firm in the market divided by the money they made in this period. So if you can interpret in this way, that so how long you can get your money back if the firm is keeping making money in this way. Okay? So market book, that's called 市净率 in Chinese. So that's market value of equity divided by book value of equity. So that's how much you want to pay for 1 unit of historical value. So that's come to the difference between the market value that you need to pay if you want to buy the firm, and the book value, that's the real historical value of the firm. So that could be a lot of difference. So why? Because you put $1 there, you can make more than $1 if you have, we call it growth opportunities. If you have a real good product. So you have some monopoly to some access to some resource or some opportunities, then you can get more money. Then you need to profit generation. So volatility, so you can get return, but it could be very volatile. You can, if you did invest, you can feel that a lot. So the market could be very volatile. So you can get a return for 100% last year, but for this year you can lose all your money. So that's a measure for how volatile your return is. So basically we want smooth return to be more certain. So here's a comparison from 1991. So the starting point, because Chinese market kind of starting from 1991. So we only have 20 years data. For US data, we have much longer. So that comparison between the China market and US market for cumulative return for these 20 years. So if you have $1 at the beginning here, for China market you get about, so that's how much? That's $20. That's $20. So for US it's just $5. You can see these are really not very good 20 years. This is not very good 20 years. For historical, for US market, the kind of average yearly return will be about 7 to 8%. So, but still you can see for these 20 years, China market, if you invested in China market, you can earn much more than in US market. But if you take a shorter period for past 10 years, from 2000 to 2010, you know, we still know that that was not a very good period for US, because in 2010 we had a bubble crash for internet bubbles. In recent years we have financial crisis. But still, we almost have identical cumulative return for two markets. So in recent 10 years, China market, they did not outperform US market. Here is yearly return, I mean for each year. So you can, for China, sometimes you can have a return more than 100%, even more than 150%. So for US market, it's more smooth. I mean, I'm not saying very smooth, but much more smooth than China market. Okay? So you can see very big peak or downturn for China market. So for this year, that's 2009, I think it's more than minus 50%. It dropped more than half. So the good years for both markets are in 1990s, but especially for China. So for last 10 years are really, really bad. So about 3% per year for both markets. China market is much more volatile. So you can also see something here. So many are arguing that, well, Chinese economy seems so separated from the world. So whatever the crisis is there, they just have 8% or 10% GDP growth every year. So it seems that, well, always growing. So maybe they are not so related to the global economy. I don't know if that's true for economy statistics, but for market statistics, that's generally not true. So even though China markets are much more volatile than US market, still you can see from figure, they generally have the same peak and same bottom. So if you run a correlation, if you know so something like that, so the correlation is around 40%. It's not low at all. So still, China market seems seemingly emulate to other economy, but the performance stock market is still highly related to mature markets. You do not enjoy very much for some very different market for China stock market. So let's see what's the price earnings ratio and market book ratio that's related to valuation. So basically a high price earnings ratio, market book ratio suggesting we want to pay much more. So we want to pay more for the firm. So that's for US. For US, because we have longer data, I started that from 1970s. We can also see a high increasing trend for the valuation from 1980s to 1990s, even to in 2000s. So for PE is now around. So the peak is around 40 for the whole market. I'm not saying for individual stock. For the whole market, it's around 40 as a peak. But now it's about 15 to 20. For market book, it's around 1.5 to 2. So for China market, it's also famous for the high valuation. So people are crazy. People pay much more money than anywhere else. So that's true. That was true, especially in early period. We can see average market P ratio around 70, between 60 and 70, around 2000. Indeed, that's also the peak of US, but that's around 40. So, but nowadays it's coming down and around 20. Indeed, at the end of 2010 or 2011, the market P ratio between China and US is not so different anymore. That's also similar for market book ratio. It used to be very high, but not anymore. Of course, we don't know what's going on in the future. So, I mean, for data analysis, something like we try to get some information from the past. We can register some link, but we never know. So that's a direct comparison. So you can see, again, whatever the separation is, they are highly correlated. But now, at the end of 2010, because we do not have enough data for 2011, but at the end of 2010, they are getting very close, even lower for China market, for market book ratio.